Welcome to Business Today, live from New York. I'm Samira Hussein. Now, we're going to start with some pretty big breaking news. Paramount Skydance has launched a last-ditch hostile bid for Warner Brothers Discovery. Now, you'll remember on Friday, Netflix had successfully won over Warner Brothers with a $72 billion offer for the takeover of the Hollywood powerhouse. Now, Paramount is going straight to shareholders with an all-cash offer at about $30 per share. And it is reportedly the same deal that Warner Brothers had already rejected. Now, in a statement, Paramount CEO David Ellison said, "We believe our offer will create a stronger Hollywood. It is in the best interest of the creative community, consumers, and the movie theater industry." Well, there's lots to talk about, and lucky for us, we have media industry analyst Alice Enders with us. Alice, thank you so much for your time. Now, first, what is your initial reaction to this hostile bid?
I think it's a bit predictable, to be honest, because we know Paramount Skydance sees a lot of value in Warner Brothers Discovery. It's also clear that as far as the shareholders are concerned, Paramount wants all of Warner Brothers Discovery, whereas Netflix only wanted the studios and the streaming business. That's why the two offers are hard to compare. I think also Paramount succeeded in getting President Trump to weigh in over the weekend. And therefore, it feels it's on stronger ground on Monday to take its pitch directly to the shareholders. And you may be aware, of course, that the shareholders have not yet signed off on the deal with Netflix. So there's lots to play here, and we might even hear from Comcast before the week is out because they were also involved previously.
Well, so I want to know, how much do you think this could actually sway shareholders? Of course, you rightly mentioned President Trump's comments on Sunday, where he expressed some doubt over whether or not the Netflix-Warner Brother deal could go through just because of how much control that potential new company would control in terms of the streaming businesses.
Well, regulatory clearance is the main hurdle. And we know that there's some important precedents, like when Disney consolidated 21st Century Fox, or when Amazon bought MGM, and they have their methods and so on. It's really hard to second guess what they're going to say, whether it's in the US, the UK, or the EU. Regulatory clearance is a hurdle for any deal for Warner Brothers Discovery. But one of the things about Netflix is that it is actually not present on the broadcast and theatrical distribution channels. And that's a big difference between those bids. I wouldn't say Paramount is going to have an easy, regulatory clearance takes time, stakeholders complain. I think, either way, it's going to be a long process until those shareholders of Warner Brothers Discovery actually get the money. But it's clear that the company is for sale. And so when it ends, it ends,
Exactly. Well, Alice, thank you so much for your time. And we'll definitely be talking about this for a little while longer, I'm sure. Now, I just want to go to Wall Street, and it opened a little higher this morning as markets bet on a rate cut by the Federal Reserve this week. Now, investors appear pretty confident that America's central bank will deliver a 0.25% rate cut on Wednesday. Now, let's speak now to Tim Pagliara, Chief Investment Officer at Cap Wealth. Look, markets have closed higher in the last 2 consecutive weeks in a row. Do we think that we're going to see the same thing happen this week?
I think the rest of the year is going to be a little mixed. The market is expecting the quarter-point rate cut this week by the Fed. There's also a lot of concern about valuation now in the AI sector. and some of the cross-pollination of the debt between all of these companies. And so I think investors are going to be very reflective as they go into the close of the year and the beginning of next year. So that doesn't necessarily lend itself to a big ripping upward market.
And what do we think going into the end of the year? I mean, we saw that big blockbuster deal on Friday. Have we seen the end of big M&A for the year, or do we think there's still a little bit more room?
I think we go into this period where it's very difficult to do M&A in the last couple of weeks of December, obviously. But the calendar is very full going into the first half of next year. There's a lot to be excited about. It will be kind of a tipping point because we'll see as some of these AI companies come to the market for equity for the first time as they try to move a little bit away from debt. The U.S. economy is very strong right now. And so I am very positive going into the first half of next year.
Tim, we're going to have to leave it there, but thank you so much for coming on the program. Now, as governments here in the U.S. and elsewhere wrestle with balancing the books and keeping debt sustainable, one economic idea continues to resurface in policy circles. Now, it's the idea that tax rates don't always translate directly into more money for the state. Now, that principle is captured in the Laffer curve, a theory suggesting that every economy has a sweet spot for tax rates. Go too low and you raise less money, but you go too high and people change their behavior, so much of the revenues actually drop. Now, push taxes really high and governments could end up collecting far less than expected. Now, and the man behind that idea, Dr. Arthur Laffer, and he joins me now, and he's the economist whose napkin sketch in the 1970s became a touchstone for the governments of Presidents Reagan, Margaret Thatcher, and many others since then. Dr. Laffer, thanks so much for joining us. Great to have you on the show.
My pleasure,
I want to start with tariffs. You've called them scary, yet you call Mr. Trump the best president of your lifetime, someone who has implemented quite a lot of tariffs since coming into office. How do you square those two things away?
Well, first place, I don't think he's going to end up with a lot of higher tariffs at all. I mean, I think he uses tariffs to negotiate better deals with other countries, solve peace problems, et cetera. And tariffs are the perfect tool for a president to use if the president is competent to use to get those other deals in, to get lower tariffs, to get peace deals in Ukraine or in Gaza. And he's used them very effectively. I worry about presidents who don't have those skills using tariffs for protection of domestic industries. And in that sense, it's a big mistake to use tariffs to protect domestic industries. But as a negotiation tool, I think it's great, and I think he's doing a good job.
But doesn't that end up having the tariffs, though? Doesn't it end up doing both? Sure, he has been able to, as you say, use that as a negotiating tool, but it also does end up serving that protective nature that you actually have always warned against.
Yeah, tariffs are like taxes. They're very dangerous tools to use, and people who aren't familiar with them don't know how to use them. They can ruin economies. They did ruin the economy. They caused the Great Depression. I mean, literally, the Smoot-Hawley tariff did, which in turn caused World War II. It doesn't get much worse than that. You then had Kennedy and Reagan lower tariff rates, which really provided a lot of prosperity. So in the hands of someone very adept and adroit at using these things for negotiations, they're wonderful tools. In the hands of an amateur or someone who's not very competent, they're really dangerous tools. And I worry about it a lot. And for Trump, I don't worry, but for the next president, I would hope those tariffs, ability to manipulate tariffs is withdrawn, and it has to go through Congress.
Now, very quickly, I do want to look forward to 2026. And where would you put the global economic outlook?
Well, let me just start with the U.S. I think we're in very good shape. The big, beautiful bill, as Donald Trump calls it, was passed, which means tax cuts begin on January 1st, 2026, excuse me, you can tell I'm an older fella. And also we have the new Fed coming in with the new chairman of the Fed, which I think will be much better run than it has been. I think a lot of the work requirements in government spending is good. I think deregulation, especially in energy and in healthcare, has been phenomenal. And we talked about trade. So I am really very optimistic about the long term of the U.S. And I think the U.S. As sort of the leader in the economic sphere will in fact lead to a great period of prosperity going forward.
Now, Dr. Laffer, I want to ask you just very quickly. We know that the Federal Reserve, America's central bank, is going to meet this week. They're going to cut interest rates. Do you think that's a good idea?
Well, right now, yes, it is a good idea. But in the long run, what I'd like to see is them to go back to a price rule and guarantee the stability of the U.S. dollar in terms of goods and services, the way Paul Volcker did, the way the Fed had done prior to, let's say, 1972, 73. I think we need to go back to a price rule where we really stabilize prices. We've had an awful lot of inflation in the last 5-10 years, and it's all been because of bad Fed policy. And we need to go back to a good, solid dollar, a stable coin dollar, if you will.
Dr. Laffer, thank you so much for joining us on the program here. Great. Well, look, I think everyone should stay tuned to BBC News for more on that hostile takeover bid by Paramount Skydance. That's coming off the heels of Netflix agreeing to buy Warner Brothers for $72 billion. Thanks very much.